morning, Steve. It's great to see you on the View once again. So this is Steve Lambeth, Portfolio Manager at Climb. Steve, you've been on the View once before, but it's great to have you back. I understand you've been very busy traveling around the country, doing client presentations, attending company meetings and conferences and so on. A busy time for you?
Yeah, g'day, Paul. It has been. It's good to catch up again, and yes, indeed, always out and about looking for insights and learnings, and it's been a real privilege to get in front of some of our investors as well.
Oh, that's terrific. And it couldn't come at a more interesting time. Markets globally have been, I guess, celebrating a change of administration in the United States. Ever since Trump was elected, markets have performed very well. But if we take over the last 12 months, I think the US market's up 32%. The Australian market is up a more modest 16%, which is half of that. But that's still double the long-term average return of about 9% for the ASX. What do you think's been the driver here in Australia? And on fundamentals, how do you think that compares to the US market?
Yeah, it's so interesting, isn't it? I think at a high level, you'd probably say the common threads is the macro comment you made before. This soft landing, no landing narrative has been shared across many markets, and so that amount of restraint from policy hiking and the tapping of the brakes not manifesting in recession has played out in a number of markets. Australia's a most interesting example of that, where notwithstanding strong inflow on a population front, strong participation in employment, the unemployment rate here is still south of where it was pre-COVID. Not many other markets actually share that accolade. So absolutely the most high level of observations would be markets are celebrating what it means to have seen the restraint on policy find its way into no recession. But I guess when you start scratching behind the surface, and I take your point, the difference in the performances of the US and Australia, just as two markets to compare, there is a difference there. But it's most interesting to see that we've seen strong leadership from the tech sector in the US. The S&P 500's, circa 35% comprised the information technology sector. If there was a word for this year to describe themes, it would be AI. Australia, different sort of drivers at work. The IT sector's done very well. It's up 60-odd% in 12 months. Much as many of those names aren't pure AI as such, they have enjoyed the same sort of buoyancy seen offshore. But that's a very small sector here. That's a sector that makes up about 3% of the ASX 200. So, underpinning really the returns that have played out in the last 12 months has been financials, namely banks, and CBA at, circa 10% of the index is up about 50% and has been a strong contributor. And then separate to that, you probably want to call out, it'll surprise some people, the REITs, because the REITs now has Goodman Group with dominance, circa 40% of that index. That has also featured strongly. And then elsewhere, it's hits and misses. There's been select consumer that's done well. There's been select staple, such as Woolworths' recent downgrade that's weighed. And then there's been really some laggards showing up in the commodities and energy space. So high level, all the same celebration, but scratching behind the surface, sectors have performed quite differently.
Yeah, that's really interesting. So on a fundamental valuation basis, I know the US is on a forward price earnings ratio of about 22. In Australia, we're on about 18 and a half. Compare that to the long-term average of about 14 and a half. And you wouldn't be too frightened off that market if the earnings growth outlook was strong. in the US it is pretty strong, but in Australia, because as you say, the resources sector and the financial sectors are such big parts of our index, the growth outlook isn't as strong. So do you think that the fundamentals are valuing the market correctly, or are we starting to look a bit overpriced?
Yeah, I think it is a hesitancy coming through is that, as we know over time, that markets do find a way, and we have to always be humble about the influence of macro on how complex these systems are, how hard they are to contemplate in what they mean for financial markets. So at all times, we're sort of guided by investment analysis that's coming from the bottom up of stock drivers. But I think one of the surprises, again, going back to the high level, Paul, would be if just to hear your quote there, the S&P 500 PE at a 12-month forward ratio of 22 times, that's alongside a 10-year bond yield overnight that finished at 4.67 or 4.7%. A lot of investors working through different market cycles would not associate 22 times with that kind of risk-free rate backdrop. If you go back to the sort of post-GFC decade up to the doorstep of COVID, when we had significant interest rate repression, and the PE of the S&P 500 over that period averaged about 17 times. So notwithstanding a very depressed risk-free rate, so to speak, and now a very elevated one, it is somewhat of a head scratch that where previously some amount of a multiple would sympathize with interest rate settings, that doesn't look to be the case at the moment. And it's also applicable to Australia, where if I moved away from a PE ratio, we know the ASX is on 18 times, and that's circa close to a 20% premium to history. If we just looked at dividend yield to make the analysis like for like, the dividend yield of the ASX is now down to 3.2 odd percent. That compares to a 10-year of 4.5%. So those that dwell on the differences and want to sort of view value in relative terms will be again probably scratching their head and wondering just why the rating's so elevated. When we look at the earnings backdrop, or at least when we look forward and ask the question, where to from here, given ratings elevated and yields quite lacking, I think the key message would be, as you just said earlier, earnings leadership now is much more in the foreground than it used to be. It's hard to promote further multiple expansion. It now is thinking about a journey in 2025 of looking for more earnings delivery. And there's probably a few things to call out on how that's shaping up for the ASX in particular. So I'll give you three things to think about here. The first would be the thought of earnings growth from the ASX 200 needs to be thought of outside of really our largest companies on the ASX. So the combination of the big four banks, which are struggling for growth, they're in a small marketplace called Australia. It's a very competitive industry. They have an anemic track record of growth. So that's a large slab of the market. The iron ore miners, the big three, BHP, Rio, Fortescue, that they are largely tied to the rope of the iron ore market, and that is becoming quite constrained because steel consumption in China has now flatlined, and meanwhile we still have some low-cost supply being introduced. So that's another 13% of the market. And then if you laid in Woodside and Telstra and Woolworths, collectively all those companies, as much as they're very entrenched and will be around for many years to come, they have all collectively not grown their earnings or dividends now for a good decade. So it's up to the rest of the 60% of the market to do the lifting. And just one thing to call out, without getting too downbeat, we've got results coming through today, and those results are always a mixed bag. But again, earnings find a way of moving up over time. But one call of caution, and why it is where just noting to clients, it's an important time to be very selective about how you're positioning. It's just that we went through an unusual cycle during COVID, as you know, a very strange cycle of inflation and where ordinarily one might think at the doorstep of policy rate cuts, we will be looking at earnings recovery. Well, we're at the doorstep of policy rate cuts with many businesses that thrived during the COVID period, whose earnings have boomed in the COVID period because they were presented with an inflation challenge that they successfully recovered through pricing. And so now that inflation's, grinding its way down as per the core inflation print in the US overnight, there's just a bit of a challenge out there. We're asking the question, what's going to drive the revenue from this point forward if it's no longer a price lever? And so what that means again is, and it's also consistent perhaps with the earnings revisions we're seeing, Paul, we're seeing a mixed bag, but by and large, post-reporting season in August, where we had modest downgrades to 25, and then subsequently AGM season has happened. We've had a UBS conference last week, and we've had a further injection of results. By and large, you would not say that we're seeing signs of betterment. We're just seeing a continuous sort of grind along with modest revisions down. So that's all featuring in how we're trying to frame what's coming in the calendar 25 year. And I think the way we're so far sizing up is we're thinking it's probably more of an income style of year than necessarily a strong year for capital gain.
Yeah. So that's really interesting. The sort of figures that I've seen just on the earnings growth story, and I'm not sure if this is borne out by your experience, but in the US, they're talking about earnings growth over the next 2 years, averaging around 14 or 16% in each of those years. In Australia, the figures that I've seen are more like 4 to 6%.
Right.
So, less growth here. On the other hand, you referenced the focus on income and dividend income. So even though the banks are very expensive, they still offering a dividend yield, a frank dividend yield of 5%, and REITs something similar. So maybe those are the sort of support levels that investors are looking for. So
the only one exception is just to call out there that's absolutely right. The one anomaly remains CBA. I certainly can't stand up and want to describe myself as knowing more than anyone else. It's a very well researched and understood company, and everyone's it's almost like the crowded trade is the underweight position that most fund managers has, begging the question, how did it get to where it's at on all manner of metrics regarding aligning price to fundamentals is not easy to explain. And I was just thinking the other day about how for any investor with a fresh dollar of capital to be buying CBA now with a 3 handle on its dividend yield grossing up to about 4%. I mean, that's with a flat earnings backdrop by and large, that's about a 25-year wait to get a full recovery of your investment. And that compares to a time ago when at $100 a share, CBA is paying about $4.60, $4.70 in dividend. That would gross up to about 7%, as you know, if you're a tax-free status investor. So that would be a 14-year wait. So again, we're always reminded that these sort of simple equations of what it means to pay a price for something and have a large outlay and then wait for the annual drips of your dividend income on the other side. It's now a very long road for the fresh dollar put to work in CBA. So that's one we're materially underweight, and where earnings haven't justified the run up, I don't think it'll be earnings changing that brings about the run down. It is liquidity and other factors at work, but our job, as you know, is just to put our best foot forward on all things, relying on fundamentals to ultimately have the most influence on long-term returns. Terrific.
So you've said that portfolios are underweight CBA, which is trading at $150 today. So a year ago it was 100, now it's 150, up 50% in the last 12 months. How would you describe other major positions on portfolios at the moment?
So in our concentrated equities product, which is our main investment product, as you know, for our largest clients and our SMA products. Paul, we're running about a 24 stock portfolio at the moment, and much as that's quite concentrated versus the broader market, it's actually more diversified. As I mentioned before, you can think of the ASX as 40% tied up in the banks, the miners, plus Woodside, Telstra, and Woolworths, and there's another 60% out there. That brings about a lot of concentration and hitching yourself to a few select sectors. We're more diversified, and the general message would be for you, just with the time we have left, we're a bit more defensively positioned than the market at the moment. That's reflected in underweight iron ore, overweight gold, overweight healthcare, underweight domestic cyclicals, and we're also underweight banks, but we're overweight real assets. So again, everything comes from the bottom up, but at a sort of a sanity check, high level and risk management perspective, top down, we're relatively defensive positioned after such a strong period.
Well, I think that makes a lot of sense, and we're sticking to our process in a kind of disciplined way. Probably we'll end off with one last question. Are there one or two stocks that you'd like to mention to investors that are perhaps overlooked at the moment, that you've got your eye on?
I mentioned earlier that we have an overweight allocation to healthcare. In part, that's a reflection upon the way that the ASX is, carries only a 7% weighting. So we've nominated to have a larger percentage of client money in the healthcare sector. It's a sector that enjoys both growth and defensive attributes. The three names we have are ResMed, CSL, and Ramsay. CSL I'll give a particular call out to. It's a very well understood large company. Of interest to you for a stat, the stock price is unchanged in 5 years, and yet the 12-month forward earnings has now increased 40%. They stubbed their toe on an acquisition in the thick of the COVID period, and the share price has suffered. But we would remind the market investors that ultimately this continued grind higher in earnings and a stagnant share price sees the valuation now in a place where I feel like we're at the doorstep of the share price reconnecting with that grind higher earnings backdrop. The other quick name to mention is Ramsay. That's a new addition to the portfolio, and much as they're in the here and the now very challenged by the aftermath of COVID with wage inflation issues alongside slow recovering activity, the main attraction to this business is that the prior chapter of value destruction from investing overseas has ended, and we also observe a recovery underway, noting that a lot of capacity is now being idled and withdrawn from lesser players in the Australian marketplace. And we also think the market overlooks the fact that the company at $40 a share and 9 billion market cap is sitting on a franking credit balance of $900 million, which has the capacity to be released should the company make further progress on righting the wrongs of international investments and sell something down the track. So we're patient investors. It's not going to give us instant gratification, but we think there's genuine hard asset backing and turnaround potential that's being overlooked.
Did you want to say something about ResMed as well, or?
ResMed, just to mention, that's been a core position, and congrats to the Climb team for putting that on in the mid-20s when the weight loss drugs reared their head. We're 12 months through that journey to see the stock having recovered. It's continued to deliver great earnings, and much as the stock's risen a lot, it's not on a demanding multiple. Both CSL and ResMed, interestingly, Paul, from a simplistic value metric measurement, are printing mid to high 20 PEs, and that compares to medtech peers, Fisher & Paykel and Cochlear. As great as they are, they're not delivering any more growth than either of CSL and ResMed, but you have to pay up 40 to 50 times earnings for those types of names. So we like CSL and ResMed.
Yeah, terrific discussion, Steve. It's been a real pleasure having you on The View this week, and I hope we will have you again sometime soon. So thank you very much. And to the audience out there, we will see you next week. Thank you.